Hi, this is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. That said, sometimes I take a different take to share with you what I believe are common perceptions on Wall Street so you can have a better understanding of how the market works and what is sort of the main thought process that a lot of investors, a lot of major institutions are considering. And regular viewers know that I do have some experience working on Wall Street, whether or not it's working in an investment bank, private equity fund, as well as working in a multi-billion-dollar hedge fund. So I have seen sort of how the sausage is made across various different angles, whether or not it's from the buy side or the sell side. And the key aspect here is that not everyone does investing the same way. The way I personally consider investing is a fundamentals driven approach. This is primarily driven off of one of my, some of my life heroes, Warren Buffett, Charlie Munger, where I'm looking at fundamentals. What does this company do? What is it worth? And what's the price relative to the fundamentals? What do I think this company could be worth in the future, considering its competitive advantages and the market size and pricing dynamics and customer relationships? So that's looking at the very fundamental driven analysis. That said, a lot of investors don't. A lot of investors focus on other variables, and I'm not saying they're wrong. I'm saying it's worth understanding, especially given that they too drive the market. I'd say the traditional value investors have become a smaller and smaller share of the market. So what do I mean by that? So one of the key elements here is momentum-driven investors, where they see what has been working, and if it stops working, they pull their capital out of it and rebalance it into things that do work. And that is an element of what you've seen with Stanley Druckenmiller's investments. And I did a video on Stanley Druckenmiller. He is arguably one of the best investors ever, over 30% for 30 years without a single down year. And he's articulated his strategy as having a couple of key points, one of which is a fundamentals-driven approach, but it is layered on with multiple different angles, like one, understanding the liquidity situation of a market. Like, hey, is the central banker given a green light or a red light? Is it tight or easy monetary conditions? Right now, as a heads up, it is easy monetary conditions, but we're probably closer to wrapping that up than starting it, just based on where we are in the market cycle. Then another angle that he looks at is what is the price action. Now, what do I mean by price action? By price action, I mean, what is the current price relative to its history? And a lot of this is sort of like looking at the stock prices or looking at a chart and saying, well, what does the price and how does it fare relative to history? And a simple metric that a lot of major investors have used for decades is a simple moving average, typically looking at like a 200-day moving average, which compares the price that it currently is versus the average price over the last 200 days, which is almost, when you're thinking about 200 business days, that's almost a year when you're thinking about that framework. And that framework can suggest sometimes you start getting price action that starts saying, hey, this thing is no longer working. You might be entering a new era. You might be entering a new period where this type of asset doesn't work. And sometimes the price action starts developing before there's a main thesis of like, oh, this is the reason why. And sometimes, arguably, price action leads the underlying events. So, oftentimes you'll see the market dip before the economy does. For example, that's a perfect example of how price action from the stock market is traditionally, historically, been a leading indicator before you see the recession. You see the price action first. Well, why are the bank sectors in the summer of 2006, 2007, why is it that we see these banks starting to take a hit and they're not really trading well relative to the rest of the market? And then eventually it all sort of falls in line. And why are these housing companies no longer working? And so oftentimes you'll get the price action move first before the thesis becomes mainstream. But the really astute investors like Stanley Druckenmiller, and I leave a link to that video here in this video, is that he recognizes these price actions, so he turns on his antenna like super sensitive to say, well, wait a second, could this be sending me a signal? So I wanted to do a similar exercise. Keep in mind, this is not how I personally invest. This is not what I do. And if you're interested in following how I personally invest, go to unrivaledinvesting.com, click on Journey, first week of the month, I call out my full portfolio. Once a month, I call out one idea that I think has multi-bagger potential, upside of a couple of 100%. That's the type of thing that I'm traditionally looking for, but it is worthwhile to understand sort of what's working with the market at any given point. Is energy working? Is speculative plays working? Is growth, value? Why? And you start sort of building out a thesis of where the economy will be based on sort of the price action today. Now, this does have its limits, which I'll talk about in a minute, but let's actually do a quick snapshot of where we are today. And so as we look at where we are today, a perfect example is looking at the ARK ETF, or the ARK Innovation Funds, which, as you can see, this line represents the 200-day simple moving average, where you can see that it's actually been below it for a little while now, for a few weeks now, which does suggest, okay, this is the red light saying, hey, you know what, momentum's getting, this is out of favor now. Investors aren't as eager. Now, maybe this is because a lot of things they own, have these assumptions where it's like, hey, this model will hopefully grow a lot in the future. Hopefully there'll be favorable unit economics in the future. So it is as a quick sort of Rorschach test, working, not working, looking at this on a very simple basis. It's not working at this point. You're getting sort of the red light right now. The downside to this type of approach, keep in mind, is that I, as a fundamental investor, when I see something drop, I do understand, and I do look at this, look at where it trades relative to the simple moving average as a warning sign, like, hey, this could go a lot lower, so be mindful of that when I'm buying. That said, my focus is on valuation. Of course, could it rip higher and go back into positive territory? Of course, but that's one should understand, okay, if you're a momentum investor and you're rebalancing your portfolio, you're not going to be adding ARK. If anything, as a momentum investor at this point, you are selling it. This is not the green light to be moving into it. So it's not working. So you start asking yourself, well, why is this not working? Why is this giving me a red light right here? And then you could look at another thing, like here's a proxy for Bitcoin, the Grayscale Bitcoin Trust, where you can see very recently it started going below that. So maybe folks are starting to say, you know what, this speculative run, and it has been quite a run, you know what, maybe this isn't going to actually be a store of value. Maybe speculative juices are starting to run out, or maybe the aggressive assumptions that you see in the ARK funds about very lofty valuation stocks with a potentially promising business model, the Teslas of the world, and I've called out how I think there's a big disconnect between Tesla and its underlying fundamentally driven valuation. Yeah, maybe that starts coming under pressure. Same thing with this sort of speculative fervor with Bitcoin. And I think this is a key element of it, which is here is the ETF for the 20-year treasuries. So long-term treasuries are clearly in a downtrend. That's sort of the signal that you're seeing. Now look, it might get a bit up, but so far the signal that a lot of investors are seeing is, oh, bond prices are going down. People don't trust federally issued or the U.S. Treasury securities, suggesting that, of course, they still trust it relative to markets around the world. This is still very low percentages, 2 to 3% interest rate, but interest rates have been going up as the prices go down. That's the relationship. As price goes down, interest rates go up. So this does reflect, hey, there might not be a bid for this. People aren't as eager to own this. And this is part of the broader thesis of, hey, do you want to own those assets that aren't cash generating, that are maybe cash losers, those long duration growth assets, when interest rates might be going higher? And that's the signal you're getting here, is right now you're getting the red light from long-term treasuries. And I also called this out with Dr. Michael Burry's investment portfolio, as he has a put position, I believe, against TLT. So he's betting against, bonds effectively going up, effectively saying bond interest rates. So rates are going higher. That's what Dr. Michael Burry's betting. And you can see that reinforced with the price action here. Now, another aspect is here's looking at gold. So as you can tell, what I'm doing here is I'm taking a cross section of various different ETFs, various different slices of the market to sort of say, well, what's working, what's not working? Can you start sort of building a thesis out of it? Because I believe this is largely what a lot of fund managers do, because it's sort of the safety of the herd versus going out on your own, which is like, oh, okay, this might be working now, I could own this, versus it's not, I need to get out of it. And that's how a lot of active major investors do think about these things. And so it's interesting to see gold getting a bid here when Bitcoin hasn't. It's broken above. It has been a little bit choppy where, going down then going up. But this does suggest to me potentially that this could be, gold might be now might be favorable. Now that's not, keep in mind, once again, this is not how I look at investing, but people could look at this, Stanley Druckenmiller could look at this and say, you know what, let's revisit the gold thesis. Okay, what do gold miners trade at? Is it a good valuation? Could I build a thesis from here to make, let's say, gold miners a big part of my portfolio because the price action is starting to be favorable, because maybe the valuation's favorable, because you have a lot of money printing, and you know what, people aren't trusting Bitcoin, let's say, as that store of value, and people aren't trusting bonds. So maybe they're saying, hey, now the bid is going for gold. Could you start making that case for gold? And so then another example is, hey, this is clearly something that investors have been bidding in, which is real estate. The real estate ETF, XLRE, that's clearly gotten a bid, making, effectively new highs over here, what you see, and how it's ramped up over the last few months. So this reinforces, okay, well, real estate, this might benefit, might get some sort of appreciation. People are bidding on it. And then another example is looking at the financials ETF, XLF, or Financial Select ETF. And well, why is this working? Well, okay, so if rates go up, what you might be seeing here is that the banks are going to be making a wider spread on their loan book. They're going to be able to write loans with higher and higher interest rates, and you know what, their deposit-based costs really haven't inched up that much, so they're going to be making fatter and fatter margins. Oh, not surprising to see that this is at near highs over here. So that's, you start building this case for sort of understanding, okay, this is what's working, this is what's not working. Another example is energy. Oh, okay, you know what, we might be entering a period of inflation, and that's why bonds are getting sold off. Okay, well, if inflation's picking up, you definitely want to own energy, and that's what you see here, the XLE energy ETF. Oh, okay, maybe we haven't been investing enough in oil production, and you know what, demand has kept up, and so if the supply goes down, demand stays flat. Now you start thinking about these energy stocks getting a bid. So this is how a lot of, I would say, investors, hedge fund managers, major institutions start looking at this, is they say, oh, okay, the price action's been favorable here. You get the green light. Does this, could we make a case? And you do look at some of the major hedge funds, and you do see them making plays in various different oil stocks like Oxy Petroleum. They're making a bet on the underlying holdings of this, and that's ultimately what's driving the ETF. So you could understand the thesis that's going on here, the sort of the top-down thesis that's driving it. And you could see here, this is along the same lines of what you got with the ARKK ETF, which is that this is a growth angle of the Russell 2000. So this is the Russell 2000 weighted by growth metrics, or the growth indicators. Growth is generally you're looking at effectively sales growth or revenue growth, and weighting that indicator. So let's weight which companies of the Russell 2000 we want to own based on which have the best growth rates, best fundamentally driven revenue growth rates or earnings growth rates. And you could see, given that it's primarily revenue growth that's driving it, you could see it's actually been fairly lackluster. Now, it hasn't given the red light yet, but relative to some of the other things like you're seeing, like energy or financials or real estate, which are all making new highs, you're not really seeing that in the growth space, where it's sort of struggling. And I would say this broadly mirrors what you're seeing with the ARKK ETF, ARKK, which is that it's these long duration growth assets where it's going to take a long time for them to be profitable, and there's going to be a real opportunity cost potentially. And that's sort of the common theme that you're seeing here. You're seeing, oh, okay, growth isn't catching a bid relative to energy, real estate, financials, and that's because and bonds are definitely selling off, at least over the last few months. And so this is sort of the snapshot of where you are, and so folks work from here to sort of build out the thesis. Oh, could this trend keep on going? Is it possible that bonds continue to sell off? You contrast the price action of the Russell growth index versus the Russell value, the Russell 2000 value weighting. So this is, weighting it by, whether or not it trades at a low multiple of, let's say, price to book, or a low multiple of price to sales. So it's less about the underlying growth and more about, well, there's underlying valuation backstop of there's hard assets here potentially that it's getting weighted on. And you can see here that's making highs over here for the year, making new highs for the year. And so relative to growth. So I would say, looking at this price action, this is still very much the thesis that, super speculative plays like, potentially Bitcoin, like long duration assets that haven't proven themselves yet, like ARKK and even IWO, which is the Russell growth, they are struggling. They haven't really caught a bid. The general psyche is still, hey, bonds are potentially going down, interest rates are going up, you might have inflation, hence energy's going up, you might have higher rates, hence financials are going up, and value is a safer haven because you have this fundamental valuation backstop in terms of, let's say, book value versus something like growth. And you can see that in their performance, at least for this year. So that's sort of what we're seeing, certainly comparing growth versus value, where value's done much better over the last few months. And so, as we look at this, what are sort of the summary thoughts? Once again, my personal approach and that of, Buffett, Charlie Munger, it's, hey, I'm not looking at these sectors. I'm looking at a company versus the valuation. And I strongly respect that approach, but I'm also open-minded. I want to, if Stanley Druckenmiller says, hey, I look at all these different angles, I want to be open to, I want to at least hear it out. Now, so I pull the trigger based on fundamentals. Like, hey, if this has multi-bagger potential, why is it? What are the fundamentals that could potentially get you to, let's say, 300, 400, 500% upside over time? And why, is this company unrivaled, and how can they deliver on that? Whereas here, when I start seeing a general sector that I potentially own that, let's say, giving me a red light, it's now trading below its 200-day moving average, it starts forcing me to ask, well, wait a second, am I missing something here in my thesis? Is there potentially, regulatory risks that I'm missing? Or is there potentially, some sort of geopolitical risk? Or it's just a general red flag for position sizing that I should consider of, like, what? This might potentially go lower. Would I kick myself if it, let's say, continues to drop and I'm not comfortable adding more to my portfolio because I maxed out the position that I wanted to? So that, it does sort of aid, it is a valuable tool to consider. It's not necessarily, how you choose how you want to invest on your personal journey. That's up to you. I personally prefer to have something grounded in fundamentals. That said, I do like to know what everyone else is considering, because it does ultimately affect prices. Longer term fundamentals do drive your expected returns, but in the short term, what's sort of driving it, what is expected? And at this point, a quick recap, people are looking at higher interest rates, generally don't want to own bonds. They're, super long duration assets like growth stocks that are unprofitable. That is unfavorable. And at this point, you're not really seeing the bid of folks saying, hey, yeah, I want to make that trade. And so then folks go, okay, potentially higher inflation. Well, what do you want to own? So you're seeing things like energy bid up, financials bid up. And, people are saying, well, you know what? Maybe Bitcoin's not that store of value I'd rather own gold. And so you start to see a bid there. And so personally, that started making me ask the question of, okay, well, maybe there's a gold miner that's unrivaled. So that raised a question for me. Okay, so let me look at gold miners and look at their cost curve. Maybe I can find a low cost gold miner, and that might be of interest to me. Generally, I don't like commodity plays, given the fact that you depend on the commodity price. You're a price taker, but low cost producers do have a little bit of an advantage, not quite fully unrivaled, but it is something that I started thinking about. Oh, okay, I see gold's taking a bid. Maybe that's something for me to consider looking at it on the bottoms up approach as well as the top down. Anywho, if this video has been helpful for you, if you've enjoyed, learning about how different funds consider momentum and looking at, layering in these different angles to their investment approach and whether or not growth and funds like ARK ETFs will get a bid. If this has been helpful for you, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.